Evercore ISI's Julian Emanuel has a year-end price target of 44.50 for the S&P 500, and he joins us now here at Post 9. So we've now surpassed your price target. What do? Do you raise it?
No, for us at this point, in the last week or so, we've seen a little bit of a shift in momentum. Okay, very much so. First quarter earnings season and the first week or so of the second quarter earnings season, stocks did their own thing. They went up on earnings, they went down on earnings. Last week, when we saw some of the bigger cap tech names have adverse price reactions, you drag the rest of the index down. So for us, this is more like a rotational environment. We think there's a churn. Positively speaking to the overall health of the market, when you look medium to long term, you started seeing buying of financials again, in large part to what Steve alluded to, is that the financial crisis risks have subsided. We like that. We think there's more of that to come. We also think there's more buying to come in energy.
But as we just talked about, there's a risk of 2 more hikes, maybe more, maybe higher for longer. That's not what's priced in the market right now. So isn't that a downside risk?
Well, I think people are getting comfortable with the fact that rates are going to be elevated for longer, and if in fact that's not going to be the case, it'll be a consequence of a recession. Our concern here is that people might be just a little bit too sanguine about the probability of recession. We would tend to agree that a soft landing is basically priced in here, but we think the probabilities of recession are probably at least 50%, if not more, thinking about 2024, and that's your downside risk.
Kalanovic over at JP Morgan, a negative strategist, says the following. I just want to get your take. Delayed impact of aggressive interest rate hikes by global central banks, dwindling consumer savings, and a deeply troubling geopolitical backdrop are poised to spur fresh market declines and volatility. Where do you stand when you hear something like that?
So, and again, this is not to downplay the risks that have accumulated over the last year, but the market has basically stood in and taken every one of those. And the fact of the matter is that when you think about it, a lot of the reason is the same reason we've been obsessing over inflation for the last year and a half, 2 years, which, by the way, we think is likely coming in quicker than the market perceives, with those bumps in the road. But the fact is that you created so much money to fight the pandemic in 2020 and 2021, and we were still buying bonds in 2022, that has softened the blow of all of these events. It hasn't necessarily preempted the business cycle. The business cycle is the business cycle. It's just elongated and put the risks probably tilted more towards 2024.
What are you comfortable with when it comes to evaluation? Given we're in earnings season, they're fine, but I mean, multiples are going up as that's where we are right now, Julian. So where do you start to say enough?
So there's no question about it. And a lot of this has been about, the fact that the Fed essentially backstopped the deposit system in March. Think about this, right? The response to that has been to rally the NASDAQ 33% in 4 months. That's 100% annualized. These things are expensive. The long-term future is bright. And if you're a long-term investor, you just sort of sit here and you appreciate the fact that you're getting north of 5% on your cash. That's the long-term picture. If you're worried, if you're overinvested, you trim a little bit, maybe some option hedges, very, very inexpensive.